Thank you very much, Professor Lee. I'm delighted to have this opportunity to be here at the Shanghai Forum. I'm going to talk about financial risks in China, and I do have a few slides to show you along the way to illustrate some of the points that I want to make. This shows us the growth of debt in China relative to GDP over the last decade and a half, and a couple of things are especially striking. There was a modest growth of debt in the first part of the current decade, but after 2007 and the global financial crisis, we see China's had an enormous increase in debt that cuts across all components of the economy. The government, the financial sector, the non-financial sector, and households all have taken on a great deal more debt. And the IMF has repeatedly said in its analyses of China that this kind of rapid buildup of debt is frequently a precursor to a banking and financial crisis. The actual situation with respect to the non-financial corporate sector is probably even worse than this McKinsey data in this slide suggests, because if you include offshore borrowing by Chinese entities, particularly in Hong Kong, you can see that the debt of the non-financial corporate sector has risen to almost 200% of GDP, which is substantially higher than the 125% that's shown in the McKinsey study. So the background is there's been a very substantial increase in debt across all components of the Chinese economy. Now, I want to give what I consider to be some mitigating factors. I do not think these data suggest necessarily that China is going to have a banking and financial crisis, and I want to give you a number of reasons why I think that's the case. First of all, going back to the previous slide, it's not clear to me that one should count the debt of the financial sector. This is basically deposits in the banking system. I think in a state-owned banking system, the probability of a banking crisis is relatively low. The depositors have relatively limited choices about where to put their money. It's not going anywhere. And the central bank has demonstrated many times in the past that it can deal with local bank runs. So that's the first point. The second point is that almost all of this debt is in domestic currency. There's very little foreign currency exposure by any of these sectors. And China, of course, still has a very positive net international financial position, so we don't have the kind of currency mismatches that have been important in other financial crises. The third factor I show on this slide, the increase in household debt is a substantial portion of the increase in overall debt, but I think this slide shows you two things. That household leverage is relatively low by standards of other economies. We're only looking at about 35–40% of GDP, and also a substantial portion of this household debt is mortgages, and the loan-to-value ratio of Chinese mortgages is extremely low, something on the order of 20 to 25%. So I don't think the household debt component of China's overall debt is particularly worrisome. The next slide I think many people find quite surprising. We have this image that Chinese corporates have borrowed massive amounts of money, but if you look at the leverage ratio, that is the amount of debt outstanding relative to the equity of these firms, there's no increase at all for the firms in the industrial sector. So this idea that China is in a position like it was in the very late 90s and the early 2000s when the banking system had to be recapitalized and massive amounts of debt to industrial firms, particularly to SOEs, written off. The situation today is very, very different. The leverage in the industrial sector is substantially less than in the second half of the 90s, and despite the overall increase in borrowing, leverage in the industrial sector has not increased over the last few years. This is nothing, you would never see this in the McKinsey study. They don't point this out. Another factor, when you disaggregate this, though, you see, if you look at private firms versus state firms, you can see that leverage in the sector of state firms has gone up quite a bit, whereas leverage in the private sector continues to go down. Private firms, of course, now produce about 75% of all industrial output, state firms only about 25%. And the situation today is, again, very different than in the late 1990s. About 40% of all the loans outstanding to enterprises are to private companies, only about 45% to state companies. In the late 90s, about 90% of all the credit to enterprises was outstanding to state-owned companies. So the share of debt in the banking system that is outstanding to companies with high and still rising leverage is much, much less than it was in the 1990s, indeed about half. If you drill down a little deeper and look at all state firms, you can see there has been a very substantial increase in debt of state firms, the black line showing us the leverage ratio of all state companies. This very much higher amount of leverage is because the borrowing of local platform companies is not counted in the industrial sector. Those are not industrial firms, but they are state companies. So what this is really showing us is that most of the increase in leverage that has occurred in the non-financial corporate sector has occurred in the local government platform companies. And I think, although I don't have time to go into it, the government announced a very comprehensive program last fall to deal with the debt of local platform companies. This is beginning to be implemented, and I think will make a very substantial difference in the overall financial situation. The next factor that is mitigating is that profit margins in the industrial sector are still fairly high. You can see in this diagram, many people have this idea that profits have completely collapsed. Profit margins have come down from their peak in 2009-10, but they're still about 6%. And this is roughly the level of profit margins that existed in China in the middle part of the previous decade, when China was growing at 10, 11, 12%. So there has been some deterioration in profitability, but it is not massive. And more importantly, if you disaggregate, almost all of the decline in profitability has been in the mining sector. For example, in the first quarter of this year, manufacturing profits actually rose 21%, and mostly because of declining raw material costs, while profits in coal mining fell by 60%. Profits in the ferrous ores mining sector fell by 49%. So profits are down, but the pain is being felt in a relatively limited portion of the industrial sector, and I think this too is a mitigating factor when we want to assess the overall risks in the financial system. I think I'm up to number 8 now, if you've been counting. The 8th mitigating factor is that China's lending is mostly deposit financed, especially for China's systemically important banking institutions. The leverage ratio is relatively low. Banks are relatively well capitalized. There's a very high required reserve ratio. And the leverage ratio is very low compared to the 125, 150% ratios that have prevailed in banking crises in other emerging markets. In other words, China's got a loan to deposit ratio around 70, 75%, not 125 or 150%. And I'm going to close on two things that I think are underappreciated. Everyone's talking these days about more financial stimulus and so forth to keep the economy growing. If you look at the actual data on the growth of credit on the broadest measure of social finance, what we see is that the authorities have recognized the risks and are beginning to take corrective action, and I think this is of two types. First of all, credit expansion last year in 2014 was 5% less than it had been in 2012. And in the first quarter of this year, the absolute amount of new credit on this very broad measure is down almost 20% compared to the first quarter of 2014. So I think the authorities are well aware of the risks. They're pursuing a relatively tight monetary policy, despite the fact that economic growth has slowed significantly, and I think that's a very good development. The second dimension of this is that a number of new policies have been announced that are reducing the share of lending coming from what Yao Yang referred to as shadow banking, or some people would call non-bank financial institution lending. This is the share of total credit coming from what I call plain vanilla bank loans. And as you can see, in 2009, it was over 90% of all credit was coming from plain vanilla bank loans. Then we had this proliferation of new products, the regulatory arbitrage in the financial system, and by 2013, the share of credit expansion coming from plain vanilla bank loans had fallen to under 50%. Now, over 2014 and the first 4 months of this year, we see a very substantial increase in the share of bank loans as the new regulations announced in 2012 and 2013 are taking effect. In the first quarter, the share of plain vanilla bank loans in total social finance was about 75%, and in April, it's up to about 78%. So the center of gravity, if you will, of credit expansion is moving towards the better regulated, I'm not saying perfectly regulated, but the better regulated banking sector and out of the less well-regulated financial channels. So I think if you take the overall situation into account, yes, the expansion of credit relative to GDP in the last few years has been very, very, very rapid, creating financial risks. But there are a number of factors that lead me to the belief that there will not be a banking and financial crisis if the government continues to pursue the policies that I've outlined, moving more of the lending into better regulated channels and slowing down the rate of growth of credit relative to GDP. Thank you.